Well, Sanjay Dutt joins us now. Let's take the conversation forward. Sanjay, good morning. Thank you for joining us. We are going through a moment of extraordinary gains. We've never seen this kind of a bunched up return in markets in last 25 years. Benchmark indices from the October low are up more than 10% and the market breadth is looking near perfect. Is this the beginning of good days ahead, or we are in the last lap now before we take a longish pause?
No, I don't think we are in the last lap. The markets would remain buoyant in the next year or two ahead. What we are seeing is identical to what the emerging markets the world over are seeing. But if you look back you're looking at just the last month or two, but if you look back on a YTD basis, I think we are nowhere outperforming anything. Markets would just about be marginally up. It's just that this event that hit us in between, it's hit the whole world. And now what we are seeing is big emerging market flows. And even within emerging markets, India is not on the top of the list. We are still somewhere we're a middler really. So I don't think this is something exceptional to India. It's just that, we've never expected this kind of a thing would happen post-COVID in March. So therefore, we are all quite surprised. Cutting a long story short, whether this would carry on in the immediate future, I don't think so. I think we are now on the higher end of the range as far as Nifty is concerned. And probably yesterday or probably in a day or two, we may log in a short-term high and then a pullback from there.
Do you see in 2021, I'm talking about the entire next year, the Sensex could cross 50,000?
Yeah, it's not far away. It may. You will definitely have volatility in 2021 also. But on a sustainable basis, I don't think so. I think there'll be opportunity other than the Sensex, in the sense that there are many other, stocks that you need to make money on. You may not make that 15 or 20% on the index, but you will definitely make that 30 or 40% on many stocks which haven't yet, kind of come to realistic valuations. So therefore, I think now on it'll be more stock specific kind of a situation than the index in itself.
You've just, on your social media handle, which is Twitter handle, a couple of days ago, you had made a case that SBI will outperform HDFC Bank and other concentrated trades like Kotak. What is the logic here? Because every time we've made a case for SBI to come back, something goes wrong here, something goes wrong there. Sometimes, even though SBI is a very cheap and attractive stock on paper, this attractiveness has not given a lot of shareholder returns.
First, one must note, my call is a next 5-year call. It's a very longer term call. You can't game the next year as far as a stock like SBI is concerned. If you go and look at some of the largest banks in China, the top 3 or 4 banks in China and what their size is compared to what State Bank of India is, and it is the largest bank, forget HDFC or forget ICICI or whatever. The question we must answer to ourselves, if we are all talking about the great success of manufacturing, the PLI schemes and everything else, ultimately, whether at the consumer level or at the industry level, there'll have to be credit, there'll have to be working capital, there'll have to be money flow. And that big money flow and the big credit conduit is got to be a bank like SBI. So if you're betting on India, there is no reason why you will not bet on SBI. And I kind of don't understand. I'm very clear, happy to keep a stop loss and again get stopped out, that you can't have an HDFC Bank or a Kotak Bank trading at a 4 or 5 times or a 6 times book, and the largest bank with so much of value in it, including its investment, subsidies, etc., will continue to trade below book. And credit quality is not going to be any different going ahead, whether it's HDFC or whether it's ICICI. And so I'm very well convinced that from now on, SBI will definitely outperform HDFC. And my analysis goes more on global comparative versus just a domestic comparative. And mind you, if you just go back and study SBI more detailed internally, the way they've gone and done their systems, the way they've gone and set right their internal management processes, I don't see any reason why SBI will not give spectacular returns from here with a combination of betting on the Indian economy.
Sanjay, what about the broader markets? How does one approach mid-caps from here on? Would you continue to look for leaders within subsegments? Are there certain pockets that are looking more attractive than others?
I'm glad you raised this question because I am convinced about one thing, that in the next 2 years, you'll see a massive outperformance in the mid-cap and the small-cap universe. The companies who survived this, entire hurricane storm or onslaught, whatever you might call it, over the last 5 to 7 years, whether it's debt restructuring or whether it's COVID or other events like GST, etc., those are the companies which will come out stronger, particularly in the mid-tier and the small caps. So therefore, your next large caps and your next multi-baggers for the next 5 years are going to come from that universe and are not going to be from the large caps. You can't expect the large caps already in that 2 lakh, 3 lakh crore, 5 lakh crore market becoming so big. Yes, they offer you safety. But for an investor like me who's relatively willing to take a high risk, I would go to good quality mid caps. There are a good large number out there. Just to name a few, I may not have positions in there. Like you may come across a Voltas, you may come across, Carborundum Universal. There's so many of them that are going around, which if you study a little more in detail, you will definitely realize that they are going to be the biggest beneficiaries of the manufacturing boom over the next 10 years, if that's what you're betting on in India.
Okay, clearly. So lots of interesting ideas also there in what Sanjay just mentioned. What about from the financial basket, Sanjay? How deep would you go there? Because there's always that element of risk or perception, that the leaders are perhaps the better bets. But we've seen a lot of traction that's gradually been building up in spurts when it comes to whether it be AMCs, insurance, even some of the smaller NBFCs. Do you see merit there?
I think insurance is a big story for the next 10 years. Definitely, quality insurance companies bought at the right price will give you very big returns. Followed by, mortgage lenders, because I think mortgage business in India is still untapped. So good quality mortgage lenders, both tier 1 and tier 2, that is the top companies and some of the second-run companies offer a lot of opportunity. That's one place to be in. And also we've got now with RERA coming in, regulations coming in, the chances of, mortgage loans turning bad or turning into NPAs, which in any case was low earlier, but with the regulated markets and with, now only quality developers remaining. So combination of these quality real estate plays along with good quality mortgage lenders in the financial space, they'll look good. Banks have already said, I think now the next 5 to 10 years, it's a decade of the PSU banks. It's very easy to find a Baroda or a Canara or a PNB to probably give you a 50% or a 70% return from here. But I think it's very difficult to find a Kotak or a IndusInd or a HDFC to land up giving you a 50% return from here. So the comparative valuations also go in their favor. But actually business will start picking up, because if you're basically buying the hypothesis that India will pick up over the next 5 years and India is the place to invest in, then I don't see any reason why insurance, financial services and banks selectively will do well,
Sure. Sanjay, this case that you're building up for SBI, the claim that you're making that you think that it's going to outperform the likes of Kotak Bank as well as HDFC Bank in the next 5 years, is it going to be at the cost of underperformance from HDFC Bank and Kotak? Or is it only a relative outperformance that you believe that SBI is going to deliver? And then the larger question is, do you need to make that tactical shift, get out of private banks and allocate higher to SBI?
Very good question, Aisha. I'm glad you asked that, because I think it'll be the former. Basically, a huge underperformance of the likes of HDFC Bank, because they'll have to manage this growth? Yes, a lot of people, give me this technology. They are way ahead in this, and bank branch system is going to go out of the way. We won't have bank branches. We just had a big controversy on social media of someone had said in 2018, in 3 years, we won't have any bank branches. But listen, we must understand that we will have bank branches of HDFC Bank, we will have branches of SBI. But from now on, we must understand that it's the question of what is cheaper to hold and buy and where will the growth really come. And I'm convinced that the liability franchise, the biggest benefit of liability franchise comes with SBI and the likes. So liability franchise is going to be a key, particularly after the episodes of the likes of Yes Bank, etc. So they are very well positioned on the liability franchise. So they'll always have very cheap CASA deposits. So their cost of fund will be much cheaper. And then the kind of reach that they have. SBI is one of the largest mortgage, in fact, I think is the largest mortgage lender in India, whereas we have standalone companies like HDFC. Look at SBI's housing loan book. And the systems, etc., all set in there. So to cut a long story short, to specifically answer your question, I think it will be outperformance of SBI and relatively underperformance, or in fact, just probably, kind of a dull movement for HDFC Bank. So yes, it's a time to shift probably from an HDFC Bank to SBI. Like always, maintain your stop loss at SBI. If you can't handle a drawdown of 30% or 20% or whatever, that individuals have to decide. Get out of the investment, but just hold on, have patience. Volatility is going to be high.
Okay, fair point. Along with SBI, Sanjay, what one is also seeing a revival in the entire PSU theme. If I just look at the 1 month returns of a SAIL, Gas Authority of India, NALCO, ONGC, BEL, which has really been on a tear, all of these are holding out well. Within the PSU cluster, beyond SBI, where do you find value?
I think 90% of the PSU move that you're seeing right now is basically coming from they were all trading at a very, very deep discount and ignored, under-owned kind of a situation. But to say that the entire PSU basket is going to now fly and something magical will happen, I don't think so. Yes, there are select opportunities in PSUs. The likes of an IOC, the likes of an ONGC, these kind of companies I think will outperform. We'll have some privatization plays. My bet is that in the next 2 to 5 years, there is no reason why government is going to remain in a company like SAIL or a company like NALCO. If the reforms have to continue, if we need resources for other social infrastructure and other hard infrastructure for the country, these resources will only come out of exiting these companies. So government will do a mixture of privatization and divestment, and that will aggressively carry on in a few years. So my bet is that look at candidates which government is more or less going to get out. There's a reason for government going to be in steel, etc. So something like a steel authority or a pullback looks good. 2, 3 others I mentioned, ONGC, IOC, etc. They'll get definitely re-rated. If government aggressively carries out coal reforms, I think there's nothing better than Coal India. So selectively, I think you will have a lot of opportunity there, but what you're seeing in the last few weeks is more out of, deep undervalued kind of deep discount kind of a situation, which you're seeing an extreme oversold situation and a deep discount situation standing corrected in the PSU basket.
Sanjay, let's look at the other side of the spectrum. The shape of the world is changing, whether it is digitization or data dominated or AI. Where do you think high growth stocks now could be identified? Ultimately, if the shape of the world is going to change, yes, capex, old economy, value stocks, they may give you a bounce. They may give you a deep swell. But the real pot of honey would be in some of the new businesses. Where are you hunting in that space?
I think there are a lot of opportunity there. And the point I'm trying to make, I'm not saying that the new business is not the place to be. We started a discussion on most of these old economy stocks, so therefore we kind of, I kind of sounded like, old economy is only the place to be. But all I'm trying to say is that manufacturing and inward-facing domestic cyclicals are going to do well over the next few years. Yes, there's no doubt the face of the world is changing. You'll have to look at companies who are adapting to this. But we must understand, within this, you will find large numbers of companies who will adapt to this change, but are traditionally old economy companies. And one such example in front of you is Reliance, what it has gone and done in the last 6 months. Similarly, you'll find many other companies who will have high-tech, user-friendly front-end focuses, but at the same time would be old economy companies, the old, I wouldn't say old economy, but would be old established companies with cash flows who would have changed their models, transformed their models. One such company I can give you, which obviously is, I think I mentioned last time also, which I'm very bullish on, is Bharti, for instance. A telecom play, front-end, consumer, the safest place to be. Because if anything has to run, any app or anything or new technology has to run, it has to run on, an internet or a mobile network. So if you want to play that theme and you can't really game as to what's going to be the next big thing, I think the simplest thing to play on is Bharti, because it's going to be the biggest beneficiary of any of these things that will pay out. And within pockets, obviously, you will find a lot of companies who will come out with consumer-faced front-end kind of interfaces who will benefit. We're already seeing some, kind of movement in some fintech plays, some insurance plays. We'll probably have some, companies coming up for listing also, like a Policy Bazaar or, those kind of companies. We're already seeing a lot of activity in InfoEdge, which is basically nothing but a collective of many of these, technology plays. So these kind of opportunities will keep coming. Like Root Mobile is one which we're seeing in front of us. I think it has the opportunity, it has the possibility of growing much bigger from here. So these kind of pockets you'll definitely see in the changing world, so-called what we are saying, the world is changing, so therefore where do we position? I think these are the places where we need to position in our portfolio.
Fair enough. Sanjay, what about consumption? I mean, even when it comes to across the board, we've seen the entire rural story play out and a whole set of stocks and segments that have benefited on the back of that. We all know that the urban sector also has to see that rebound in order for things to really get moving. But given what the story we've seen play out so far, how would you then slice and dice consumption, and where would you find value?
I think on staples in particular, and on discretionary consumption, I'm a little underweight at this point of time, tactically in the short term, because I think, one, they are priced to perfection. Second, I think you will see some amount of a slowdown. What you've seen in the last 2-3 quarters, there's some pent-up demand come in, so therefore you've seen numbers surprising everyone. But I think there's going to be a problem, and particularly if you're talking about, a commodity price increase, we're talking about, steel, aluminum, other imports, soft commodities in particular. I'm very optimistic and bullish on soft commodities. So if that be the case, then obviously these consumption plays, their margins are going to be a little under pressure. And there's very little differentiation really that's there between them. A lot of other players are coming in. So, what you say is downtrading takes place. So I'm a little wary out there. I wouldn't be overweight on that sector. I would have it in my portfolio. But at least in the short term, I will be underweight over the next 3-6 months.
Fallen, and UPL has fallen by 10%. Of course, the Economic Times today, ET Prime edition, is carrying a story on a whistleblower complaint which is there against UPL. We only have those details. I don't want to speculate here. Yes, markets have been very, in a sense, they've not been very convinced about why these corporate governance concerns are coming for UPL. First, the whole Mauritius issue of the auditor resigning, now whistleblower complaint, which ET Prime has done a story. We try and get in touch with management to get their sense of what this whistleblower complaint is. Is it a new complaint? Is it an old complaint? Has the whole allegation gone through the board, or this is something which is completely new in the domain? Sanjay, let's talk about a stock like ITC. And every time when I ask this question to experts that why ITC, despite such superior averages, great return on equity, so much of cash, FMCG business going up, is underperforming. Before I finish the question, the answer is a very simple acronym, ESG. Can we divide the world so bluntly? Non-ESG is bad, ESG compliant is great because that's what markets are doing?
No, I disagree on that. I have a very clear reason on why ITC has underperformed. ITC has underperformed because of inefficient management at the company, management of resources, management strategy. I think the management needs to wake up and understand what they are doing. Look at, for instance, they have a very small company, which may not be relevant here, but just kind of shows the strategy and psychology of management or the style of management adopts. They have a company called International Travel House, which they've been nurturing for, before I started my career, probably in this business. Now, similarly, they have the hotels business. They're into so many businesses which are cash guzzlers. You can't really understand as to what the management is up to. And the biggest problem that I see with the management is what we have seen in some of the recent, episodes and fiascos we've had in some of the large banks. We've had these people, non-promoters, sitting at the top for last 35 to 40 years. I can tell you 5 or 7 people who've been sitting in the top management at ITC for the last 25 or 30 years. Nothing new is coming up there. Conveniently, cigarette profits are coming. You are just throwing them to FMCG. You are throwing them into hotels. And you are not really finding ways of creating shareholder value. So it's not got to do with ESG. It's not just you keep generating cash and you're giving dividends, so there's yield, so therefore shareholders should be happy. Shareholders are looking for growth. Shareholders are looking for a proactive strategy from a management. You cannot run the enterprise in a manner the way it's being run. That's what my assessment as an analyst is. I think it's very important for ITC to find ways to unlock value, whether that's going to be, hive off the hotel division, get it off their balance sheet into a separate, efficient company, run properly. Similarly, now it may be a time to get out of the FMCG business from the main company and just have ITC one cigarette company like Godfrey Phillips focused, right? And then you have other companies which are properly run by managements and teams. So it's not got to do with ESG. It's a clear message going there. That's one reason. And second, I think the biggest reason we are dealing with right now is the holdings that Government of India has to SUTI. Till that is not sorted out, the ITC stock will not perform because that's the biggest overhang is dealing with. Government has to take a decision because that stock itself is worth 40,000-50,000 crores. Now, whether government makes a strategic sale, government makes a offer for sale or whatever, that's again an overhang. All large investors know that's got to go out of the way in the next few years. So these are the two reasons and not ESG, in my opinion, why ITC is underperforming.
Appreciate your time, Sanjay. Certainly hope to see much more of you going forward. Always appreciate your time and your deep insights on contrarian investing.
Thank you, Nikhil. Thank you for having me.